Welcome back to the 7 Investing Podcast. I'm Lead Advisor Steve Symington, and today our guest is Lauren Hein of ROBO Global. She's the head of advisor relations. Lauren, why don't you tell us a little bit about what keeps you busy every day?
Well, Steve, we're talking technology, but maybe not like the most traditional technology. But I mean, who isn't talking tech these days? So that's probably not all that unique. But we're a robotics and automation research and advisory shop. We have some ETFs that track our indexes, and that honestly, robotics and automation is where we're spending the bulk of our time right now.
Wonderful. I love that you kind of go outside the normal tech box as well. There's a lot of, when people think tech, they're scared right now because we are kind of right in the middle of the worst pullback in tech stocks in particular since 2003, if I'm not mistaken. And that makes people kind of scared. And I think that's part of what I'd love to start talking about right away is kind of the case for tech in your portfolio, even amid this sell-off. How are you thinking about that right now? Why should people not abandon it entirely at this point?
Sure. Well, we can't abandon like a major growth driver of our economy, first of all. But I think when we talk tech, a lot of people just think owning the Nasdaq or the FANG stocks, the big tech, hardware, software type technology companies. The way we think about owning technology, especially right now, is saying, if technology is really driving innovation forward, let's think about it outside of maybe the traditional GICS classifications. Let's really think about it as who's innovating, and maybe we need to get a little creative. For example, my robotics and automation index, ROBO, Robo. So if you hear me refer to Robo, that's it. It's 40% invested right now in capital goods, in industrial manufacturers, because to us, we talk about robots and we talk about automation, but that requires some manufacturing equipment and that automation equipment, and someone has to make those machines. So that to us is technological advancement, but it's going to be industrial manufacturers. So, we still own a lot of tech companies. AI, another place that we're seeing, real productivity gains and real advancements in driving tech and big data. There's like cybersecurity. There's all of these actual software solutions that we still want to own, but we don't just stay in traditional quote unquote tech. Right.
And that's when so many people think, tech, they think of these mega caps, and you have, Google, Amazon, Meta, it's the parent company of Facebook. Google's actually Alphabet now. And I've written a fair bit about how there is so much opportunity outside of that. And we're looking at like lagging small and mid caps. And I love how you're thinking about this as it's necessary technology that kind of operates often behind the scenes. And you kind of touched on industrial manufacturers. How do you think about sort of the way they fit into robotics and automation, that ecosystem? Can you touch a little more on the way you think about that?
Yeah, for sure. So automation is the number one trend in technology right now. Gartner did a survey recently that said 80% of organizations plan to continue or increase their spending on automation technologies. I'm going to use some really easy examples, and that is manufacturing automobiles. Last year, installations of industrial robots in that automotive sector was up 37% year over year. So we added about 110,000 units of industrial robots. So maybe I'm far off your question already, but the excitement around automation is wholly cross sector. Non-automotive sectors, there's some other good examples about robotics applications in manufacturing metals. That was up 40% last year. Semiconductors, everyone's talking about the shortage, electronics, those manufacturing solutions were added about 23%. for more robotic solutions. The same thing in like ag tech and farm tech, food and consumer goods, 21% growth last year in the manufacturing solutions implemented. So it's fully cross sector. It's not probably names that big tech needs to get into some of these spaces because they have such explosive growth numbers, and mega cap companies like that really do need to find places with big opportunities to see real growth. But right now, it's just a lot of kind of small and mid-cap companies globally that are doing a lot of this, really innovative automation technology work. My robotics index, if you ran it through Morningstar, we're considered global SMID. So there's that to speak to big tech, or maybe in my case, the lack thereof.
Yeah. And I think something that's really important to note at this point is, we've talked about, worst pullback in tech since 2003. And you look at the Nasdaq, all the constituents, every stock listed on the Nasdaq index right now. I think almost 50% of the companies listed are down at least 50% from their rolling highs. And there's some speculation that maybe as we have the Federal Reserve kind of removing some of the liquidity from the system, we get some more pain there. But they've already been smashed so hard. I can't help but wonder if we see perhaps some relative strength from these companies that are already beaten down, because their performance is being masked, I think, by the relative outperformance of some of these mega cap names, your Amazons, your Metas, your Alphabets. How do you guys kind of think about allocating money when you have funds that way?
So yeah, I don't want to bang on the Qs too much, but if you actually look at the Qs have about 102 stocks in it. If you look at the effective number of holdings, meaning the number of companies actually driving the performance of that index, it's only 24. So there is a lot. I mean, if half that index is down more than 50% off its peak, you're not experiencing a lot of that drawdown, because the bulk of the performance is being driven by just a few of those mega cap names.
Right.
Now, to your question about how do we think about investing in, was it tech generally or automation stocks?
Sure.
Our investment criteria is to look at, we've defined what we think is a very long-term, multi-decade theme, if you will, and thematic investing has really become all the rage called over the last 5 or 6 years or so. And then we look at that long-term theme and we say, does this company have market leadership? Do they have technology leadership? What are the investments that they're making in these innovative technologies and their growth prospects? We also obviously look at their financial quality. Are they a takeout target? So we really try to stay in at least our kind of corner of the world true to that long-term theme. Not something that's going to be, glamour stocks, not something that's going to be a flash in the pan. We're not trying to chase performance. We want long-term disruption potential.
Right. So let's talk about that. Maybe, I think maybe this sort of environment favors, or is increasingly favoring, stock pickers and people who can find individual businesses. And I know there's a few stocks we wanted to talk about that maybe you guys are watching kind of closely to that end. So perhaps maybe we start on the Japan side. I know you've talked about, I think you mentioned before that Tesla is notably absent in several of your ETFs, but perhaps some of the companies supporting them are not.
Yes. Yeah. So Tesla's a really fun example. It comes up in all of my meetings because it is very innovative. They grab the lion's share of the attention when we're talking about electric vehicles. And then, the next kind of level of thinking there is autonomous vehicles. And they're obviously working on that technology. I'm based in Dallas, and down in Austin, they just put in the Gigafactory, which is 10 million square feet of manufacturing space. But we are actually looking at a company or companies like Fanuc is one that we want to talk about. We're super excited. They actually make the manufacturing robots that are used to manufacture Teslas. So you can you're experiencing the growth of the manufacturing robot orders, which, as an aside, auto manufacturers were 40% of the robot orders. That's up 15% year over year. So they're doing a ton of automation. But that is an industrials company. We classify them capital goods and industrial machinery. It's critical to the entire ecosystem of manufacturing. And so you don't have to get trapped in a conversation about Tesla, about Elon Musk, about, at this point now, Twitter. We're just trying to talk about, efficiently and accurately manufacturing EVs.
Right.
Go ahead. Well, the last thing I'll say on that factory automation is in one of our strategic advisors actually just threw a chart out recently that it's in a very firm upcycle. If you just look at quarter over quarter demand change, the outlook through next year, even firm growth in factory automation, and we just said automated or both.
And if you've never heard of Fanuc, it's FANUC is how you spell it. It's ADR's American Depository Receipts. If you're looking for a ticker, trades over the counter, and I believe its ticker is FANUY. You can find it that way. But Japanese company, and if you're not familiar, you've probably seen their products before and little Tesla fly-throughs on their videos where you show the robots assembling everything. These are the kind of robots that it supports. It's not all Tesla technology that you're seeing in those videos, even though it's very, very cool. But why Japan? Why? I know there's some reasons kind of underlying how companies like this are coming out.
Yeah, I want to stay on Fanuc really quickly. I visited some friends in Detroit just a couple of years ago. And as I was leaving and driving to the airport, there was a parking garage, and the side of the parking garage was an advertisement for Fanuc. And it was, we're here and we're investing in Detroit, we're investing in your community. And so they're not exclusively manufacturing or providing manufacturing solutions for Tesla. They are everywhere.
Right.
And you'll start, like you just said, the videos, when you see it, you'll start to see them everywhere when you see them. Another example of another manufacturer that we used to own, we don't anymore, is KUKA. Just want to give them their due. But the question about why Japan. So Japan very much led the way, and it has led the way in automation, especially in some of these industrial manufacturers, because they have a pretty severe population decline, and they've been really confronting their aging population for quite some time now. So when you stare down, you would like to continue the economic growth, but you stare down a labor force that continues to decline, and they really don't have any immigration policy to speak of, and they're not having enough children to replace the people leaving the workforce. You've got to start thinking about automated solutions. So one of our strategic advisors actually just did an interview about this, and if you in my lane, you can actually find it. There's kind of this race to see who's going to be the leader in automation and in robotics technology, and Japan came out the gate extremely strong. And so the US is going to need to start we need to start confronting this, in that we've had a shrinking labor supply despite the fact that our working age population continues to grow.
Right.
But we've got to start thinking about how robotics can be a solution for, say, wage inflation and the high cost of living now across sector. And frankly, importing a lot of those industrial machines is a really good first step to thinking about doing more automation, manufacturing automation, specifically here in the US. I'll give you, last fall, we talked a lot. You started to see that the help wanted signs everywhere. And then it was all the pictures, $18 an hour, $21, $25 an hour. It was a huge conversation. There's a restaurant here in Dallas that uses robots that zip around the restaurant and actually bust the tables. So you put the plates on the robot and it takes them back to the kitchen. There's also Jack in my neighborhood that uses one to take things from the back of the kitchen, like the part of the kitchen, up to where they're finishing the plates by the window before they come out. And so they're not running those ingredients before they bring them out. They're actually putting them on a robot that moves around. Last fall, Forbes did an article called Rent a Robot. There was a number of articles actually just about cobots helping human workers do higher value work, and the robot can work alongside you and assist you, and you can actually rent those pieces of heavy machinery, essentially, instead of having to purchase them, which makes them very scalable for smaller businesses.
Right.
So it's innovation and it's automation, and it is getting much more mainstream, if you will.
Right. And I think that's a topic, that you've just kind of brought up, robotics as a service, and not necessarily asking companies to spend tens of thousands, in some cases hundreds of thousands or millions on to outfit a warehouse full of robots, so you can automate things that way. I think we're going to see a lot more in the realm of robotics as a service, and companies asking for that. Actually, about a year and a half ago now, I think I did an interview with Lior Elazari. He's the CEO of Invia Robotics, and it's very, very similar to Amazon's Kiva robots. But he said one of the things they've moved toward, because a lot of companies are unwilling to spend so much money to outfit an entire warehouse with robots, is robotics as a service, where they say, we'll pay you this much every month, and we'll lease your robots. You take care of the maintenance and take care of all that for us. But it should be really interesting to kind of watch that unfold. And also on the consumer robotics side, so companies like iRobot providing iRobot Select, where you can pay them $29 a month to get a Roomba and a new one every 3 years, and they replace them if anything happens. And definitely an increasing trend. But you also touched on another topic. I think maybe before we move on, there's another Japanese company, Yaskawa. We can talk about in a minute.
Sure.
But before we go there, you touched on another topic, kind of labor replacement, and how do we think about, we're automating things. We have restaurants that are bussing tables. We have warehouses that are doing this. How do we think about people who might step out as critics and say, you're replacing our jobs? Like what happens? These are jobs that we wanted. And is automation bad in that sense? How do we walk that line?
It is a fine line, and I would avoid going to either extreme, right? You don't want to be fighting automation because we want to stay global leader, have a global leaders in technology and production, and we want to have a strong economy here. But also, you can't be, robots are going to replace all of us, and we're all just going to sit around living these like lives of leisure and meaninglessness. But technology is changing the way we work and the type of work that we do. I just saw, I want to say this year's World Economic Forum report predicted that 85 million jobs will be displaced by automation by 2025. And that is incredibly significant. We know that, and Robo talks a lot about the fact that more jobs have been created because of automation than so far have been lost.
Yeah.
But there is something to the fact that there may be higher tech jobs, that people doing more blue collar manual labor type work, they're going to be the first replaced. And so there have to be solutions, and I don't know what they are, and I don't know that we want to be, informing policy or anything like that. There do some solutions to perhaps re-educate part of our workforce, and to be willing to say, okay, the jobs that are coming down the pike are going to be more tech adjacent. Someone's got to be able to fix this manufacturing, the more nuanced equipment that we're bringing into warehouses. And there are more specialized component parts that are kind of one part technology and the other part engineering. So it is going to happen to some degree. I don't know the pace of it or how extreme it's going to look. I don't know if that means we're going to have conversations even about like the way we are educating people coming out of high school. Do we all need a 4-year diploma? And, or should we be talking, should I get something, a certificate that is tech adjacent, or learn more of the kind of engineering behind the technology? I don't know, but it is something that comes up in every conversation that I have. And they're big questions that will require some probably creative answers.
Yeah.
But again, if we can avoid going to either extreme, I think that's going to be key to have some reasonable discourse around the job loss that will continue and the job creation that will continue because of more advanced automation.
Right. It does tend to inflame, I think is maybe a kind word, because there's people who are frustrated because perhaps they've lost a job to automation, but also on the other end, you have I think it is crucial to recognize that more jobs are being created than are lost, but they're different jobs.
Yeah.
And they're human-centric jobs. They're jobs that only people can do. And as we become kind of more productive as a world, as a global society, even though maybe people are talking about globalism being destroyed in the process of all this craziness, but that's an entirely different podcast.
Everything comes and goes, right? That conversation we find ourselves in every few decades.
Yeah.
One more thing I want to say on that. I grew up in essentially the Rust Belt in a small farm town in the Midwest. And my kind of first memory of any of this is the Corning factory in my town during the late 90s, early 2000s, stopped making those Pyrex dishes, the like glassware, and started making fiber optics cable, and then instantly had to close because the tech crash, right? And so the way that factory came back to life in my little farm town employed maybe 20% of the people that it did before. So this has been happening for a long time. And it is very personal to like where I come from. My parents still live in that little farm town. But something, and I don't want to hand out like a ton of homework, but something that I found very interesting was a book by Kevin Roose, who's, I believe, a New York Times columnist and author. That he wrote a book called Future Proof, 9 Rules for Humans in the Age of Automation. I've sent it to so many friends and friends with kids. It just talks about if the world is going to automate, how do we be of value as people? And in a lot of ways, that's really leaning into the things that make us uniquely human. And you'll never outwork the machine. The AI in your computer is always going to be more efficient than you, whether we like it or not. So how do I adapt to that and educate myself for that? And then really lean into our human, communication skills, et cetera, to work well with the technology, because it's going to happen. And and for those of us in the workforce now, it's hard to change, but like we have to really choose to adopt this stuff, because it's happening. It's happening in the software and for the manufacturing and all the actual, like, the Chipotle is testing right now a new like chip cutter and fryer, like all the way down to the guys working at, behind in the kitchens and fast food. It's coming for all of us in some way. So we need to embrace it and have a plan for it, I think.
Right. And actually, maybe we skip Yaskawa for the time being, because I feel like we're on a good tangent right now. We're talking about Rust Belt. We're talking about America, and I know there's a couple American companies you guys have been keeping an eye on as well in the industrial focused robotics realm. Cognex was one I think you wanted to mention. By all means,
we're talking about investing, right? Okay, so let's talk about the industrial manufacturers that we're looking at right now. So I mentioned earlier there are about 80 companies in our index of what we call robotics and automation. About 15% of those are 40% are industrials or capital goods manufacturers. That does include some like tech equipment in there. But 15% of that index is trading on an EV to sales ratio of less than 1 time. And the bulk of those are in the industrial manufacturing space. So just to give you an idea of how cheap that is, if you have a negative EV to sales, it means your company can buy itself with its own cash.
Right.
And so we're trading less than 1 time. Like they're incredibly oversold in our opinion.
Right.
Part of this is because they're getting slammed by the supply chain disruption. We've talked a lot about how there are shortages in semiconductors, and we need to do a lot more manufacturing there. And it might be a long time before we actually get up to speed with the demand for chips. But it's not just chips. It is reduction gears and microcontrollers, optical and motion sensors of different kinds, linear motion guides. So a lot of these nuanced component parts to this machinery are not being delivered in time for these manufacturers to actually deliver the goods that on the orders that have already come in. So we think that's a huge opportunity. Teradyne is a company, you're asked about one specifically that's US based. They're based in Massachusetts. They are technically a semiconductor company, but they fall into our application and industrial automation and manufacturing subsectors. I believe Teradyne might also be don't quote me on this, but they also might be in my artificial intelligence fund.
Okay.
They supply test equipment for semiconductors.
Right.
So they are doing 5G testing solutions, testing chips, and frankly, I mean, they've got a really impressive list of clients. It's Samsung and Qualcomm and Intel, Texas Instruments here in Dallas. They are the highest in their peer growth at expanding their gross and net margins. Last year, their gross margins were up 60%, net was 27%. And they've had incredible top line growth. So their net income 2 years ago was just under $500 million, called 460 million, to over $1 billion in just 2 years. They also have a cobot segment that we're really excited about. They are doing robot picking, autonomous forklifts, cobots that can work alongside humans. And that business segment within Teradyne is growing at about 40% year over year. So tons of potential for that as well, although it's not like the core of their business right now. So we're super excited about Teradyne. They are US based. We love an American company. But so Teradyne, the ticker is TER.
Yeah. And Teradyne's also interesting because modest dividend. I think last check, it was like a 0.4% annual yield. So very small there, but trading near 52-week lows. Again, TER is the ticker. Compelling stock. Actually, I want to take a closer look at it. It's one that's always kind of been on the back at the bottom of my watch list, but I feel the need to propel it higher at this stage. But
anyone growing alongside the build out of the 5G network and also chip manufacturing, we feel pretty good about the direction of that business.
Right. And so maybe before we move on to maybe the other business that I mentioned earlier, how do we think about those supply chain challenges and chip shortages and everything, because that's undoubtedly a headwind right now for them, but not a permanent one. Yeah. So how do we think about how to approach that as an investor right now?
Oh God, I don't know if I had the answer to that. It's for the companies that are manufacturing this equipment, they have two problems. One is they can't get the component parts in to actually deliver on the orders that are already here. And then two, they're just having trouble physically shipping things. So when they're ready, are they getting to where they need to go? So it's two problems. And I don't know how fast we're going to be able to loosen the log jams in the supply chain, especially shipping back and forth to Japan and Korea in these examples, at least.
Go ahead.
Go ahead.
I think the other important thing to note, and we've talked about this a little bit, is that this isn't a problem with the company. It's a headwind that's kind of outside its control right now. And I think that's an important point to note when you're looking at any business. Is this a problem with demand for its services, with its products? Is this a fundamental challenge with its financials? No, it's something that should prove temporary. And I have no problem personally taking advantage of temporary issues with otherwise strong businesses. So that's one of the things I love about a lot of these companies in the space that are being challenged by those headwinds.
You're still seeing very strong sales growth in these companies. And yeah, if you like things on sale, I like things on sale. This might be an opportunity to buy these companies and trust that the shipping and the supply chain and logistics issues will continue to loosen up, whether it's next year or 2 years or whatever, they will. And we do know that these companies are still seeing order growth and sales growth. So I don't want to touch on FX too much, but with American manufacturers getting kind of more bang for their buck with the strong dollar, that doesn't hurt either.
No,
we're able to buy more equipment to automate more places, and these manufacturers are largely Japanese and Korean.
Right. So let's pivot from Teradyne to the other company. I know that you guys are watching kind of closely, Cognex. Tell me about Cognex.
Yeah, Cognex, also Massachusetts based. It's a tech hardware company, essentially. I know for a fact we include this one in my AI index and in my robotics and automation index. Within Robo, it's considered computing and AI,
Yeah.
which that AI piece is about, like, call it 15% of the fund or the index. And then AI, we actually consider it factory automation, which is interesting because machine vision is like 95% of the revenue from Cognex. One really cool application for this technology is that they're using machine vision to automate quality control. So software and sensors that can really identify defects in anything coming off a line, essentially at the point of assembly.
Right.
The machines are obviously faster and more accurate than having people do the work. I don't have X-ray vision. I don't know about you, but it's incredibly it reduces costs. We avoid recalls. We have better quality control when we can use the machine vision right before something leaves the actual line.
Yeah.
Another, interesting technology that that we're excited about within Cognex is their edge intelligence software and their 3D scanners. They're basically able to take all of the big data that is spread out.
Right.
And that comes from reading barcodes and from doing the quality control, the data from those machine vision tools, essentially. And then you can send all of that information up to the cloud for nearly instant data organization and analysis. So it's real-time performance monitoring, which again helps you be very streamlined and efficient. And that's their edge intelligence software. Also some 3D scanning in there that we really like. So Cognex, again, a US company, but we're super excited about what they're helping manufacturers achieve.
Right. And CGNX is the ticker on Cognex. Also, a modest 0.5% yield on the dividend and trading near 52-week lows, as with so many other things. But that's a business that I've talked a little bit about for anyone who attended my How to Think About Investing Robotics podcast a couple of months ago. Cognex is a pretty compelling business, about an $8 billion market cap right now. So, I mean, given the potential in the markets it's addressing, I can't help but agree that it should be near the top of your watch list.
By our estimates, only about 4% of the factories in the US are using some sort of technology like this. So that's huge upside potential. Right.
And which seems almost silly. I hate to, it feels like such a clear ROI for a company implementing a service like this, but I hate to have businesses learn the hard way that they should have had something like this implemented, because it's almost like what if we didn't have this? This could be a whole lot worse. These machine vision systems and quality control, but again, just a small part of what Cognex offers, but maybe what it's known best for. Some of those adjacent markets are compelling sort of bits of optionality for a company like Cognex.
We love, like, everyone likes to talk about the exciting new technologies. And so it's the point of production quality control is something that I find to be very relatable, no matter who I'm talking to in the world, where they live, if they're in metro, whatever. So yeah, it's an exciting, super applicable technology, very specialized. And yeah, I do think you're right that you would hate to learn the hard way. Recalls are very expensive. Doing it twice, very expensive. So they're providing a lot of value for companies that are working with them.
Right. And also, I love just all the behind the scenes. This isn't so much consumer facing technology, but it's increasingly necessary technology. And I think all the businesses that we've mentioned so far on this podcast episode are businesses that kind of operate that way in the background, but increasingly necessary, increasingly high returns on investment for companies that actually put their money to work that way. So perhaps we should consider investing accordingly.
We couldn't agree more. Stay away from the stuff that's like always on TV. Perhaps we don't want to be quite so famous.
Right. Exactly. Well, good. I think that actually should give listeners plenty to chew on at this point. Thank you so much for joining me, Lauren. It's always a pleasure.
Lauren, thanks for having me.
Thanks, everybody, for listening to the 7 Investing Podcast. Again, I'm Lead Advisor Steve Symington, joined by ROBO Global's Lauren Hein. Thanks again.